Well, the market continues to be in negative territory, and sort of the hallmark of today has been that there's not been too much meaningful buying, though yes, in the last couple of minutes, you've seen the market come off at least the lowest levels of the day. Mayuresh Joshi is now joining in. Mayuresh, as we say hi to you, it's been an excellent day for some of the oil and gas stocks, both on the upstream front where ONGC is now rallying 4% and on the downstream front where oil marketing companies are rallying. What would you do with these stocks?
Again, to a large extent, Surabhi, I think the CPSE ETF buying is something that might be just one of the reasons that might be propelling the moment in these stocks. But again, I think clearly for this sector as a whole, the moment of crude pricing is essential and extremely critical from an earnings sensitivity perspective. And the other element also becomes the rupee-dollar move. So I think how these variables are expected to pan out, which is very difficult to gauge in volatile times like this, over the next few quarters is going to be a key benchmark in terms of the overall performance. The second element obviously is if one really assumes and expects oil to stay between $60 and $70 a barrel, the rupee to probably move between 68.5 and 71. I think with these assumptions on the lower and the higher end of the range, I think the stocks might be bound because what probably happens for downstream companies, say for example, I think the kind of investments that they're probably doing at this point of time, I think they are probably going to eat into the cash flows. At the same time, I think when you're probably talking about the expectations on the refining margins front, I think the middle distillate players are clearly going to benefit with new IMO regulations coming through from 1st Jan 2020. And the third element obviously becomes the diversification in terms of their product lines itself. So for IOC as an example, I think if you've got the pipeline business, you've got the petchem business, the throughput is quite good. So you've got multiples assigned for each individual leg of their business. Add to that, as I said, I think the capex will add on to their capacities over the next few years with larger complexities. And again, the investments that they've made, I think the dividend yield probably holds out for them as well. So again, I think all these cases might work out for them, but I think IOC among the downstream companies is somewhere if somebody has a holding from lower level should continue holding.
Okay, fair enough. Well, Anuj, I guess not much has changed. Maybe some buying in some of these PSU stocks that we've been discussing. But aside of that, Nifty Bank still down 300. So what thoughts now, 10 minutes away from the close?
Yeah, Dow futures have recovered a bit, sort of be down about 26 points. I think the market's assumption is that, after a 460-point decline in the Dow on Friday, today at least there should be some amount of recovery.
Some stability, yeah.
That's a dangerous assumption because, the market's overbought everywhere, and yes, the second half could get very treacherous in Europe as well and US as well. So that could be a dangerous assumption. I think the price action clearly is indicating that this market now wants to complete some kind of correction. And this is still a market which is net long. You saw the FI data. There was some short build-up after a long time on the option side, not still on the future. This again, that trap rally or the trap recovery like we had on Friday as well. It could happen because, tomorrow morning you could again face some kind of gap down if, in the second half Europe falls and US also sees follow through. And who says that, after a 460-point fall, it's necessary that you'll have a rally. You can fall as well. So it looks like some kind of global correction is on the way.
Though, of course, the US also reacted with sort of, a lag. The Fed meeting happened in the middle of the week, and that time first there was initial euphoria and cheer that, oh, wonderful, they're not hiking rates. Yeah. And suddenly people woke up to the fact that, oh, this could also be bad news for the economy. Let's see how the Americans make up their mind as overnight action gets underway. But for now, there's more market opinion coming your way. And this is a view coming in from Hiren Ved, Director and CIO at Alchemy Capital Management. He, in fact, thinks that the next couple of months are going to be pretty good for emerging markets. He also talks about his top sectoral calls.
While the rest of the EM pack was rallying, we were grossly underperforming. And I think we are seeing a catch-up rally since then. I think the overall context, longer term for emerging markets seems to be quite positive, given the fact that most central banks are back into easing mode, given the global growth concerns. And I think it's usually a 8 to 10 year cycle. I think post 2008-9 the developed markets did phenomenally well, especially the US markets from 2010 onwards up until 2018-19. And I think now slowly we believe that the next 7-8 years could be back with emerging markets. and India could be one of the better placed emerging markets, given the fact that it's still a largely domestic driven economy.
Are you concerned about the reports of a slowdown that we're seeing in our own markets across pockets, whether it's autos, whether it's consumer durables, appliances, etc.? Do you think somewhere that could sort of derail the market?
I think we are finally seeing the delayed impact of the NBFC crisis on some of these sectors like auto, and there are multiple things, insurance costs, and the delayed impact of NBFC crisis. So I think, but I believe that, a lot of that should get reversed in the second half of the calendar year. Obviously, a monsoon will also play an important role, but I think that this slowdown should be fairly temporary.
I guess also there's been this debate in the market whether what we've seen, this journey back to 11,500, whether that was a function of a lot of pre-election buying, there was just a lot of money coming in, or a lot of the emerging market catch-up that you referred to. And if there's a question mark on global growth and if this whole conundrum about inverted yield curve, etc. continues, then could that be a bit of a risk to the FPI money that's been pouring in?
My view is that this year should be good for emerging markets. Now, whether this flows continue or ebb down a little bit, it's very difficult to say. My view is that you will see, FPI flows continuing to be strong, and I think DII's flows starting post-elections. So you could have a pretty good scenario, couple of weeks and months down the line.
In terms of how to play this market, then last year was all about IT.
Right.
That continued for the first, couple of months. Then we saw some kind of reversal. Now the bank nifty has just been soaring, and you have all kind of banks contributing. Sectorally, how will you approach this market then?
So I think the bank nifty is doing well because of two reasons. One, obviously, is that it's now 40% of the nifty, right? So if you get passive flows, you are going to get money there. But I think it's also because if you look at the delta change in profitability in the nifty, right? We are all calling for a reversal in the tepid earnings going into FY20. And a large part of that delta is the delta by the corporate banks, right? So if you look at core earnings, EPS growth might be 15-17%, but because the swing for the corporate banks will be significant, you could end up with a 22% kind of an earnings growth for FY20.
Apart from banks, what else would you... I heard you mention that, DII flows may resume post-elections once there's more clarity. Where do you see value now?
So I think more than value, it would be good to see where do we see earnings growth now, right? And I think earnings growth continues to be in private banks, continues to be with some select NBFCs. I think the consumer sector will continue to see earnings growth. We've seen volume growth improve, last quarter. We may see autos bouncing back maybe in a quarter or two.
What about this whole idea of waiting for the elusive cyclical recovery, waiting for the, the industrials to pick up? Do you see that happening? Would you look at buying those kind of stocks at all?
You will see a cyclical recovery in the second half of the year. Now some of that could be played through corporate banks, and some of that could be played through things like cement, autos, and maybe even select capital goods companies as well.